Hello, Steve Vanderway here. Excited to share with you some market update. We're going to be meeting together next week for our 10-year celebration. You may or may not be signed up for that. Even if you are, we're not going to have a lot of time to cover these things. So I wanted to make sure I got these out ahead of time. So this will be valuable for you to watch right now. I want to cover the year-to-date performance. The volatility of the last couple of weeks has been a lot in the news. And then the U.S. stocks versus international stocks. So with that, here's the year-to-date through last week on the U.S. Performance. This is a U.S. large company. You're getting these returns for the investments that you own inside the free market fund. So you are getting these returns, but you're also invested in the market in the international markets, and you're getting these as well. And so a lot of the media is talking about the increase that we've seen in the U.S., and you're looking at your portfolio saying, hey, my portfolios are pretty flat. Well, the reason they are is because you own all of them, and as you own all of them, it moderates or mutes the returns for 2018. Now, the other point I wanted to make is the volatility of the last couple weeks. Now, we've seen the market drop by more than 5%. It also happened to have dropped by more than 5% earlier in the year. So the point I want to make here is that these 5% drops are not uncommon. A 5% drop in the market in the U.S. large, 10% of the months on any given year since 1926 has a more than 5% drop. 17% of them are 5% increases. So this is hardly newsworthy. If it is newsworthy, it's certainly not worth panicking over, and the volatility that we've seen in the last couple of weeks. Now, this is a fun chart. It color codes the different asset classes. There's 12 different asset classes here, and they're color coded. And the white ones are the S&P 500 index. And what we're looking for is where does the S&P 500 index end up to be the highest, and that happens to be in the 1990s. One time, the S&P 500 was the best performing asset classes. Now, you own all of these in any given year. The S&P 500 was the worst performing asset class 14 times since 1970. The point there is that the S&P 500 is not the lowest performing asset class of all the asset classes. You'll see that again in a couple of the other charts. This is showing the balance strategy. Now, your free market funds are really these blue squares in the center. It's more the middle of the road, and that's where it should be. The S&P 500 19 times outperformed the diversified portfolio that you have, the globally diversified portfolio. 29 times it underperformed it. So again, we have a lot of attention on the S&P 500 only because the last 5 years the S&P 500 has done fairly well, but over time the S&P 500 is not your best friend. And then this highlights just the emerging markets. 9 times since 1970 the emerging markets finished last. That's what we have it here, but 11 times they finished first. We want to own emerging markets. So just because emerging markets aren't the best performing asset class in 2018 doesn't mean we abandon them. When we look back over time, the S&P 500, the emerging markets has been a good friend to a diversified portfolio. So this is a chart that just shows where the asset classes are. We've highlighted returns. The S&P 500 is right here at the bottom. Again, the lowest performing asset class since 1926 of all the asset classes that you own. And this is the growth of a $10,000 investment starting in 1926. The point being is we want to own them all. We're not running away from the S&P. We want to own all the asset classes, not just that one. So the lowest expected return of any U.S. asset class over time is the S&P 500. In the aggressive model portfolio, you own 7.5% of your money is in the S&P 500. So just because that's up this year doesn't mean your portfolio is going to be significantly impacted about that. And what you don't know, and most of us only hear about the S&P 500. The media camps on that asset class. If that one's not doing well, nothing's doing well, and that's not true. So your portfolios are working very, very well. You have a lot of reason to be confident, and right now would be a great time to keep investing in the markets. We are very optimistic for what the next 10, 12, 15, 20 years can do for you. Thanks so much for listening.